The profound impact of early investing and the mechanics of compounding wealth over time is often misunderstood. A man sits alone at a kitchen table in 2026. He is 28 years old. His salary is decent. His phone screen glows with stock charts, crypto prices, and investment reels promising wealth. He tells himself he still has time. Maybe next year, maybe after the promotion, maybe after the car loan is cleared. Across the city, another man closes his laptop after investing the equivalent of a restaurant bill into a broad market index fund. Nothing dramatic happens. No instant fortune appears, no fireworks, just a small transfer into an invisible machine. 40 years later, the difference between these two decisions is no longer measured in hundreds of dollars. It is measured in freedom. One retires with options, ownership, and time. The other is still selling his hours to survive. The real question is why the financial system rewards time more aggressively than intelligence, effort, or even income itself. In 17th century Europe, merchants crossing oceans face a brutal problem. Trade voyages take years, ships disappear, so financiers in Amsterdam begin experimenting with shared ownership. Investors pool capital into enterprises that survive beyond individual voyages. For the first time, wealth creation becomes linked not just to labor, but to patient capital accumulation over time. A famous example appears in an old mathematical legend. A king rewards a scholar for inventing chess. The scholar asks for 1 grain of rice on the first square, 2 grains on the second, doubling each time. By the 64th square, the amount exceeds all the rice the kingdom can produce. This is compounding. Consider 2 investors. The first begins at 22, contributes for 10 years, and then stops entirely. The second waits until 32, but contributes larger amounts consistently for decades. Intuitively, most assume the second investor wins. When you buy shares of a broad market index, you are buying fractional ownership in companies designing semiconductors, building infrastructure, and developing software. The machine requires patience, and patience collides violently with human psychology because the market rarely rewards investors immediately. At first, the growth curve appears almost flat, but eventually the slope steepens dramatically. The mathematics simply reached escape velocity. Warren Buffett becomes the most famous example. Much of his wealth accumulates after age 50. Longevity matters as much as skill. Market crashes expose weaknesses. In 1929 to 2020, fear overwhelms long-term logic. This time is different, they say. A 25-year-old enduring a recession still has decades for recovery. A 65-year-old does not have the same margin for error. Investing early is no longer merely a wealth-building strategy. It is becoming a structural necessity in the modern economy. Because the greatest advantage of early investing is consistency, not excitement. Start today and let time build your freedom. The modern retail investor lives inside an attention economy designed to reward stimulation. Long-term investing is structurally unstimulating. That is precisely why it works. The investor checking portfolios every 10 minutes experiences markets differently from the investor contributing steadily for 30 years. One sees chaos, the other sees accumulation. This difference mirrors findings from behavioral finance researchers like Daniel Kahneman and Richard Thaler, whose work demonstrates that humans consistently make irrational financial decisions under emotional pressure. Investors feel losses roughly twice as intensely as equivalent gains. This phenomenon, known as loss aversion, explains why market crashes trigger panic selling, even when long-term fundamentals remain intact. Headlines focus on volatility because volatility captures attention. Television networks frame market movements as a crisis. Financial influencers promise shortcuts because patience is difficult to monetize. But beneath all this noise, the underlying engine remains surprisingly simple. Own productive assets, stay invested, give compounding enough time to operate. The most effective investing strategies often feel emotionally unsatisfying. A diversified index fund is boring. Automated monthly contributions are boring. Ignoring short-term volatility is boring. In 1975, a quiet revolution begins when John Bogle launches the first publicly available index fund. Instead of trying to beat the market, investors should simply buy the market itself. Decades of evidence tell a different story. Most active managers fail to consistently beat broad indexes after fees. Complexity often creates the illusion of control without improving outcomes. Successful investing no longer requires predicting individual winners. It requires exposure to long-term economic growth. The index fund becomes a machine for capturing global productivity itself. To understand why early participation matters, imagine 2 identical engines. The first starts operating immediately at low power. The second waits 10 years before activating at higher power. In exponential systems, delayed activation can become impossible to overcome because compounding rewards duration disproportionately. A small amount compounding for 40 years can outperform much larger amounts. Young people possess the most valuable investing asset, time, precisely when they have the least money. Older investors often possess more money precisely when they have less time. Consider the global financial crisis of 2008. Banks collapse. Housing markets implode. Yet beneath the panic, long-term investors accumulate ownership in productive assets at discounted prices. Today's markets operate at extraordinary speed. Algorithms execute trades in microseconds. But beneath this technological complexity, the core logic remains ancient. Capital seeks productive growth over time. Investing is tied to productive value creation. Speculation depends on price movements. One is rooted in ownership, the other in prediction. And prediction is notoriously unreliable. Inflation is often misunderstood. Structurally, it alters the relationship between time and money. Cash, sitting idle, experiences silent erosion. Investing early becomes a race against monetary decay. Ownership compounds, delay compounds too. This leads to the central contradiction. The economy encourages consumption, while wealth accumulation often requires deferred consumption. Investing early connects to autonomy. Money is rarely the final objective. Control over time is. The investor building assets early is gradually purchasing future flexibility. The people who achieve lasting stability understood the mathematics of time before time became expensive. In the end, that is what investing early truly purchases: future freedom.